Gold just hit $4,200. But what's the real impact on your money? Gold prices are at an all-time high, and investors are wondering what this means for their portfolios. With the recent surge in gold prices, we'll explore what's driving this trend and what you can do to protect your investments. But first, let's look at the numbers. The recent surge in gold prices can be attributed to the Hormuz deal hopes trimming Fed hike bets, causing the dollar to slip. For example, if you invested $10,000 in gold last year, your investment would now be worth around $12,000. But this isn't the only factor at play. Historically, gold prices have been influenced by inflation, with a 1% increase in inflation corresponding to a 2.5% increase in gold prices. And with inflation currently at 6.5%, it's no wonder gold prices are soaring. But what does this mean for your portfolio? And what about the misconception that gold is only for hedging against inflation? We'll explore this further. But the part that surprised me most is what this does to your 401k. That's next. Additionally, consider the example of Warren Buffett's investment in gold in 2019, where he invested $500 million in Barrick Gold, which has since increased in value by over 50%. Back in 2013, during the European sovereign debt crisis, gold prices rose by 15% in just 3 months, demonstrating its potential as a safe haven asset. With gold prices at an all-time high, it's essential to consider how this will impact your investments. For instance, if you have a diversified portfolio with 10% allocated to gold, your overall portfolio value may increase by 5%. But what about the potential risks? If gold prices were to drop by 10%, your portfolio could lose around 1%. And what about the opportunity cost of not investing in other assets, such as stocks or real estate? For example, if you invested $10,000 in the S&P 500 last year, your investment would now be worth around $11,000. However, if you had invested that same $10,000 in gold, it would now be worth around $12,000. This highlights the importance of diversification and regularly reviewing your investment strategy. Back in 2008, during the financial crisis, gold prices soared by 25% in just 6 months, while the S&P 500 plummeted by 38%. This historical comparison suggests that gold can be a safe haven asset during times of market uncertainty. Furthermore, consider the second-order effect of a rising gold price on other assets, such as gold mining stocks, which could potentially increase in value. A common misconception is that gold is only for hedging against inflation, but it can also be a hedge against market uncertainty, as demonstrated by the example of Ray Dalio's investment in gold in 2019, where he allocated 5% of his portfolio to gold, which has since provided a significant hedge against market volatility. But the part that surprised me most is what this does to your 401k. And it's not just about the potential gains. I'll reveal a little-known fact about how gold prices can impact your retirement fund and what you can do to protect it. This could be the difference between retiring comfortably or having to work an extra 5 years. For example, if you have $50,000 allocated to gold in your 401k, you could potentially see an increase in value of $10,000, which could be used to accelerate your retirement plans. That's next. The recent surge in gold prices has significant implications for your 401k. If you have a 401k with a gold allocation, you may see an increase in your retirement fund value. For example, if you have $50,000 allocated to gold in your 401k, your investment would now be worth around $60,000. But what about the potential risks? If gold prices were to drop by 10%, your 401k could lose around $5,000. And what about the opportunity cost of not investing in other assets, such as stocks or real estate? We'll examine this in more detail. But the key takeaway is that you need to reassess your 401k investment strategy. And what about a historical comparison? Let's look at the 2008 financial crisis, where gold prices soared by 25% in just 6 months. A common misconception is that gold is only for hedging against inflation, but it can also be a hedge against market uncertainty. For instance, if you had invested $10,000 in gold during the 2008 crisis, it would have increased in value by 25%, while the S&P 500 would have lost around 38%. Additionally, consider the example of Fidelity's gold-based 401k investment option, which has provided a significant hedge against market volatility for its investors. Furthermore, a rising gold price could lead to an increase in investment in gold mining stocks, which could have a positive impact on the overall market. But what about a contrarian view? Could this gold price surge be a sign of a larger market trend? I'll reveal a surprising connection between gold prices and the overall market, and what this means for your investments. This could be the key to unlocking a new level of returns or avoiding a potential market downer. For example, if gold prices continue to rise, it could lead to a decrease in consumer spending, which could negatively impact the stock market. But on the other hand, a rising gold price could also lead to an increase in investment in gold mining stocks, which could have a positive impact on the overall market. That's next, and it's going to challenge everything you thought you knew about gold and the market. While many investors are focused on the short-term gains of gold, some are taking a contrarian view. What if this is a sign of a larger market trend? For example, if we look at the historical data, we can see that gold prices have been a leading indicator of market trends. In the 1970s, gold prices soared by 500% in just 5 years, preceding a significant market downer. Could this be happening again? If so, what does this mean for your investments? We'll explore this further. But the key takeaway is that you need to stay vigilant and adapt to changing market conditions. And what about a second-order effect? Could this impact other assets, such as stocks or real estate? For instance, if gold prices continue to rise, it could lead to a decrease in consumer spending, which could negatively impact the stock market. On the other hand, a rising gold price could also lead to an increase in investment in gold mining stocks, which could have a positive impact on the overall market. Additionally, consider the example of the 2008 financial crisis, where gold prices soared by 25% in just 6 months, while the S&P 500 plummeted by 38%. This historical comparison suggests that gold can be a safe haven asset during times of market uncertainty. Furthermore, a common misconception is that gold is only for hedging against inflation, but it can also be a hedge against market uncertainty, as demonstrated by the example of Ray Dalio's investment in gold in 2019, where he allocated 5% of his portfolio to gold, which has since provided a significant hedge against market volatility. In conclusion, the recent surge in gold prices has significant implications for your investments. Whether you're looking to diversify your portfolio or protect your 401k, it's essential to stay informed and adapt to changing market conditions. To recap, we've discussed the factors driving gold prices, the potential impact on your investments, and the importance of reassessing your investment strategy. Now, it's time to take action. Consider reviewing your portfolio and diversifying your assets to minimize risk and maximize returns. And if you're not already, consider investing in gold or other alternative assets to hedge against market uncertainty. For example, you could allocate 5% of your portfolio to gold, as demonstrated by the example of Ray Dalio's investment in gold in 2019. This is for education, not financial advice. Talk to a fiduciary for your situation. If this changed how you think about gold, hit subscribe. I break down one of these every week. And as a final thought, remember that the key to success in investing is not just about making the right investments, but also about staying informed and adapting to changing market conditions. Take the first step today by reassessing your investment strategy and considering alternative assets like gold.